Very easy. So the parent, we know the parent has 80% shareholding in this subsidiary. So we just take 80% of the 55 and we say the parent has 44 of this post-acquisition profit, which sometimes you can also call it PAP. You can also call it PAP. Good. And the NCI has the remaining. You have two ways of calculating this. You can either get the difference between 55 and 44, or you just take your 20%. If you want the examiner to know that you understand this thing, 20% of 55. But basically, it is the difference between 44 and 55, and that brings 11. I believe we are together. We are together there. Now, this share of post-acquisition profit, that goes to the parent, which is 44. We are going to use it now to calculate our NCI. The one that goes to the parent and the one that goes to NCI. We've already demarcated and separated the two. But now, let us now continue with our NCI at reporting. We started by fair value at reporting, which was 39. But then here I said the next step is to add share of PAP, which is the post-acquisition profit. Yeah, and we already have it because we are dealing with NCI. What is their share? I will just refer to this 11 here. You can see that is the share that we've just calculated. That adds on to the NCI at reporting. But remember, these minority shareholders or the NCI, they have to share into the impairment of goodwill. You see this impairment we did here. This impairment, the NCI, because they also have some shareholding in this subsidiary, they have to share. So it will reduce their stake. It will reduce their value. So we less there, share of impairment loss. We call it impairment loss, and we know it is goodwill that is being impaired. How do we get the share? We know that NCI, they only own 20%. So we just take 20% and we multiply by the impairment of goodwill. What is the impairment loss? It was 15. So they have to share into the 15. But because we are supposed to less, I will just introduce a negative there so that it comes out as negative like that. Yes. So this should be share of like that. So let us finish up. I'm finishing up very fast because this one is the last. I think this is the last calculation I'm doing because we've already done. Have we done investment in associate? No, but that one will not take even much time. Now, when we come to this, the next thing we are going to do is to get the total net effect, and that comes to 47, which will be our NCI at reporting. Those are the elements that affect the value of NCI. And this value of 47, which is our NCI at reporting, is what we take to the statement of financial position consolidated. And here it is. What is NCI at reporting here? We just bring our 47 like that. We've seen how we calculate it, so there is no problem. Now, we only have one thing remaining, just one. I know time is moving, so let us just do this one calculation and we are through with everything there. So this one calculation is which one? Let us do investment in associate. After doing investment in associate, this retained earnings, the retained earnings at reporting will be the balancing figure. So we'll not even calculate it. So it is only one step, just one, and we are going. So this working here, we call it investment in associate. This is the only working remaining. So let us do it very fast. Investment in associate, we start by how much did the parent pay to acquire this associate, which is the cost of the investment. And from the start of the question, we were given the cost of that investment. You can see 24 million in KPLC. KPLC is our associate. So you just take the 24 million which the parent paid to acquire that associate. After that, was it 24? No, this 24 is the retained earnings. Let me see. Yeah, this is retained earnings. The parent paid for 70. Yes, 70 million is here. This is what we need to pick, not the 24. We need to pick the 70 million, which the parent paid to acquire the associate. Then we also remember that we are looking at the value of the associate at the end of the financial period. But there is also a profit which they make. How do we get to know if the associate made a profit or not? We will compare retained earnings at the date of acquisition and retained earnings at the date of financial statement. That is very easy. We just go here. Look at this statement of financial position. Now let's look at the associate part. Associate at the date of reporting, the retained earnings was 97. But at the date of acquisition, the retained earnings we are given here 24 million. So it was 24 when they were being acquired. But at the end of the year, at the end of the financial period, at the date of reporting, the retained earnings had grown to 97. What has happened? There is an increase in their retained earnings. Increase in retained earnings is because of profit. So they made some profit. That's how we are getting that growth, and that one adds on to the value of the investment in associate. So here I will say add share of PAP. I can just call it PAP, post-acquisition profit, because an associate is also being acquired, though we did not consolidate it fully, but we are getting its investment by the parent. Now, this PAP, we are getting what the percentage the parent has. The parent only bought 40% of this associate, but remember, I've just said, if you want to know the associate made a profit or not, compare their retained earnings at the start or at the date of acquisition and their retained earnings at the date of reporting. And I've just shown you where we get those ones. The retained earnings at the date of reporting is in the statement of financial position, which was provided here. And you can see it is 97. 97 is the retained earnings at the date of the financial statements. And we compare that with their retained earnings during acquisition, at the date of acquisition. And that one we were given from the start. Na tuliambiwa hapa, 24 million in KPLC. That was their retained earning balance. So we compare that 97 and 24, we realize that 97 is greater than 24. That means that was a profit. But the parent only takes 20% of it. No, 40% of it, because that's what they own in that associate. So that gives us the 29.2. Then you remember at some point, the parent sold something to this associate. You remember the highlighting I did, the yellow highlighting? I believe you still remember. There was that UPS downstream. There was that UPS, downstream UPS. Let me just trace the highlighting. Here it is. Here it is. The parent and associate. I can even just bring the whole of this thing down here so that you can, I can even just bring it here. This one. But if I bring it, it will interfere with our calculation. So, but I believe you remember how we calculated the UPS. Now, this total UPS, unrealized profit on stock, it is being shared by the parent and the other shareholders. Parent only has 40%, but the other group, the NCI, not really the NCI, but the other shareholders who are making up 60% have the remaining part. But here, because it is the parent consolidating, we only take our share. The rest, we don't care. What is our share? Our share is only 40%. Our share is only 40%. And it is 40% of what? It is 40% of what? It is 40% of this 6 million, which we already calculated. And that's how we are getting our 2.4. But remember, we are subtracting it. So I will introduce a negative sign here so that we deduct the unrealized profit. This is fake profit, so we cannot add it. Now, if you look at the additional information, I don't remember seeing anywhere where we were told that there was any impairment in the investment in associate. The impairment which you were given here is only for goodwill. Associate, you were not given if there was any impairment. Someone was saying something. Mwalimu, the profit there was 12, not 10. Where? Have I picked a wrong figure here? The profit was 12, not 10. I don't remember. Can you be specific so that I know if maybe there is a mistake I've done somewhere? Because I don't understand. I'm right. Okay, let's continue. I'm right. Let's continue. Now, I was saying that we were not told if there was any impairment in that investment in associate. So because there was no impairment in that investment, we are not, because if there was an impairment in the investment in associate, if it was in the additional information, we would also reduce the investment in associate with that value. But because it is not there, this is all that we need. This is all that we have to affect our investment in that associate. I don't see if there is anything else we are leaving out under associate. So that gives us our investment in associate. Associate at reporting. This is the investment in associate at reporting. This is what we are taking to the consolidated statement of financial position. So I will come here and put it in very fast. Where is the investment in associate? Here. So I will just refer to it, 96.8. There you go. There you go. I don't know why this alignment is not okay. Let me just even put it there. There is no problem at all, not at all. I just like them being aligned on the same line so that we do not have tattered workings. Good. So with that, you remember we've calculated all that we needed to calculate, except there is this one element that we've not calculated, but in an exam room, you do not even have to struggle. Don't even struggle to calculate retained earnings. Once you've done your investment in associate, you've done your goodwill, and you've done your NCI, you've done more than enough. So what do you need to do? Just get the balancing figure between the total assets and your total equity and liabilities. That balancing figure is what should be the figure to go to your retained earnings. But we can still go ahead and even get this retained earnings figure. But for now, let me just put it here. And you can see that will balance off our account. And we can prove it. We can prove it. Retained earnings. Retained earnings. Let me just grab your 2 minutes. Retained earnings at reporting. Let me just grab your 2 minutes. I know you are late. Let me just get your 2 minutes. I know you are late. Time is moving. I can see it is 6:48. It's almost 7. Now, if I can take your 2 minutes and show you that we can prove to see, is this our 327 correct or wrong? This is our retained earnings. Let's see if it is correct or wrong. Very fast. We have all that we need, my friends. You don't even have to struggle. All that we need, we have. Now, where do we start? Let us start by the retained earnings, because if you look at the statement of financial position, we were given the retained earnings of the parent. And this one is at reporting. So that is where I want us to start from. So retained earnings of parent at reporting. Because that is why, you know, the parent is the person consolidating. It is the parent who is consolidating. So their retained earnings is very important. And remember, all the other equity elements, we only took the ones for the parent. So therefore, their retained earnings, the retained earnings of the parent at reporting is where to start from. It is very important. It was 278. Let's start from it. And then after that, we ask ourselves, what other activities affected the retained earnings of the parent? What other activities? You know, the parent acquired the subsidiary and the parent acquired the associate. And the parent has a share of the post-acquisition profit in the subsidiary, and the parent also has a share of post-acquisition profit in the associate. And we've calculated all those things. All we need to do is just to bring them over. We just want to confirm if 327 is correct. Now, what do? We add, because this is what also increases the value of the retained earnings in the parent, because now they're a group. Now we add share of PAP. PAP means share, post-acquisition profit, and it is their share from subsidiary, and then associate. We get the shares which they got in the subsidiary and the share they got from the associate. Now let's start from the subsidiary. We already did it. Where did we calculate? Where did we get the valuation of the subsidiary? The PAP. You can see here, look at the working which we did here, and you can see the parent got a share of 44. That's what we pick. And in the associate also we've just done. Let's look at also in the associate. In the associate, we know that we've gotten the share of PAP, but this one was for the NCI. And I told you, this one, let's just calculate it. I told you that the parent only has 40%. And to get to know whether the associate made a profit or not, we compare the retained earnings at the date of reporting and at the date of acquisition. At reporting was 97. We compare with the retained earnings at acquisition, which was 24. Tumepewa hapa, you can see it here. That gives us the profit they made, but the parent only takes 40%. Now, what does 40% give us? You can see it is here, 29.2. I believe tuko pamoja, you understand. Now, what other thing or what other activity will affect retained earnings at reporting? Now, remember, the parent sold some goods to the subsidiary, and it also sold to the associate. This not number one. The parent sold to subsidiary, and the parent also sold to the associate. We already did all the calculations down here. We do not even have to worry. We are just transferring figures. Now, if the parent sold to the subsidiary, you cannot sell to yourself. Members, you cannot sell to yourself. Whether you sold to the subsidiary, that is selling to you, and the profit you make there is fake. That profit will reduce the value of retained earnings. We normally know, we've already covered a statement of financial position statement or income statement, and you know that profit which you get from the income statement normally is added to the retained earnings in the statement of changes in equity. So that unrealized profit will reduce the retained earnings figure. That's why we are subtracting. I believe now you understand. Now, we are lessing the unrealized profit on stock, and this unrealized profit is from the subsidiary and also from the associate. From the subsidiary and from the associate. Now, what was the UPS in the subsidiary? Now, let's go to the subsidiary. Let's go to the subsidiary. Where did we get the valuation of the subsidiary here? Valuation of the subsidiary is here. And you remember when we were valuing the subsidiary, no, let me just go to the additional information. I don't want to take much time looking at that. Now, we were told that the parent sold goods worth 32 million to the subsidiary, and they made some profit. And this profit that they made, we were able to calculate UPS. Where did you calculate UPS? UPS, we did it here. And our UPS, when they sold to the subsidiary, how much was the UPS? How much was the UPS? How much was the UPS? The UPS was 10, right? This one here. You can see the UPS is 10. That is when the parent sold to the subsidiary. So as the parent, we are supposed to take the UPS in the subsidiary, and we subtract it from the retained earnings because that is a fake profit. Then we also take the fake profit when you sold to the associate. What was the fake profit when you sold to the associate? We've just gotten it here when we were calculating the UPS downstream. The UPS downstream was 2.4. You remember this one, but the parent only was to take 40%. 40% of that. And that's how we have our 2.4. But because we are subtracting, I would want to introduce negatives. We are confirming our retained earnings figure, but in an exam room, I still repeat, you do not have to struggle, do that. Don't struggle to calculate this. But if you have time, you can confirm. Why not? So we can do that. Then there is also, when we were calculating goodwill, you remember we did some impairment. Less impairment in goodwill. We know goodwill is part of the assets, and assets adds up to the value of a company. So when goodwill is affected, then it affects the total equity of that company. So in any impairment in that goodwill will also translate and affect the total retained earnings at reporting. So what was the impairment, the impaired goodwill for the subsidiary? Impairment we were given in note number 5, sorry. The goodwill was impaired by 15 million, but as the parent, we only own 80% of that subsidiary. So just get 80% of 15 million, but we are going to subtract. So let me just introduce negative to make it negative there, like that. Then in the associate, was there any impairment in associate? I don't remember seeing any impairment in our associate, so that will just remain 0. That was not given. Then now I think, have we considered everything that affects our retained earnings? I think yes. If I look at this additional information, this intracompany sales, fair value adjustment do not affect the value of retained earnings there. NCI, no. Impairment is only on goodwill. So I think we have all that affected our retained earnings. So here I will just get the net effect. The net effect there, and this one should be retained earnings at reporting. So kindly confirm if our retained earnings we are getting here is the same as the balancing figure which we got in the previous one. Where was it? We got our balancing figure 327. Here it is. So guys, we were correct. And we've confirmed our retained earnings at reporting is the same as the balancing figure after we calculated NCI, goodwill, and investment in associate. So members, that's what we are required to do in this question. This is what we are required to do in this question, and I believe you've gotten the concepts. And I say, and I still repeat, the most important thing is you understand the concept. The questions might be twisted, but if you have the concept, you know how to go about it, then you'll be home and dry. But remember, you might not have enough time to calculate all this in an exam. All you need to do is to harvest the low-hanging fruits. How do you do that? Draw your pro forma. After doing your pro forma, then start doing the basic entries before you come to the complicated ones like retained earnings and NCI and investment in associate. You shall have harvested more than enough marks so that even if time cuts you short, you are still good. So thank you so much, guys. Let us meet tomorrow. And tomorrow, like I said, let us start with the pilot paper, December 2022. I just needed to touch on this consolidation, but now I think we are good with it. Though we've not done consolidation of the income statement, but that one is very easy because you know that one is normally prorated. In a balance sheet statement of financial position, consolidation is 100%, as if you own everything. And I believe you have grasped something there. Thank you so much and have a great day ahead.